What's up, everybody? Today we're at one of my facilities and we are going to go over occupancy. And we're going to talk about the relationship between occupancy rates and what you might be missing, whether you are managing yourself, having a third-party management company, or somewhere in between. A lot of problems that we're seeing in the market today are actually easier fixes than you may think, and a lot of people are not looking in the right place. We're going to go over that and show you where to look and some things that will help you. The first thing that we need to remember is that all units are different, and we call these products, and they have customers because the utilization of these unit types are different. So we're doing product market fit. This is actually really important when it comes to occupancy. Obviously, the biggest mistake we see is not understanding your customer. When we're looking at a small unit versus a mid-size unit to a large unit, climate controlled, drive up, drive in, they have different customers and they want different things. New people coming in building assume that a door is a door, and this skews things and it can really create problems that end up resulting in bad occupancy. And a lot of operators can't seem to figure out why our occupancy isn't rising, why I can't push rates. Over the last 3-4 years, that has been masked. Artificial demand was so high, as you can see in these charts, as occupancies that soared to 96%, which is totally not normal. We do not see storage facilities historically being at 96% occupancy. It was more in line with 86. That meant that all units had so much demand and people had to have them and they needed them for moving that even if they didn't want a particular size, they were going to take it because they had nothing else. That is not the market we live in today. They have choices. They have actual opportunities to get different types of units in different sizes. That means they don't have to take that size of unit that you put up that was full 2 years ago and had been, but isn't full anymore. And now we're seeing in markets play out which units are in high demand and which ones are not. So let me show you some numbers here. This is an actual facility of mine, and the numbers that are shown are the 10 by 10s and the vacancy. And I do this with all our facilities. What we're doing and looking at here is the vacancy by unit type. And as you can see, the vast majority of the vacancy is held in just one unit type. We have a problem here because one of the products is not fitting the market and hitting it where it should be. Now, this could be an individual facility problem in a short mile radius, or this could be an overall market problem. Too many 10 by 10s. In this case, that's what this was. As you can see, 10 by 10s are the problem. And what do? Well, this is one of the beautiful things about storage. We can do a lot. We can change our offering, which we did at this facility. All we did is change the offering that we were giving. So instead, we said 10 by 10s aren't in high demand, but 10 by 20s are. All we did was shifted the way that we were offering it. Because what we did is now we hit that target market that needed that space. Now we're saying you're getting it at a discount. Why? Because there's 2 doors instead of 1, and there's a wall. People said, that's great. I'm okay with 2 doors, even if there's a wall in between, as long as they're right next to each other. I can use it, I can fill it up, and I get it at a discount from the same size of unit that somebody else may have. That filled up 9% occupancy in just 2 weeks. In other cases, we'll do other things like move walls. Now, we've done that on this facility. This facility right here is a large facility that we bought a long time ago, and they had vastly overbuilt 5 by 5s. This large facility that was built out of metal casings, it had walls in 5 by 5s. We could easily come in at a low cost and change walls, and then we literally changed the unit size. That took it from 60% occupancy up to 96, and we were able to push rates. So why does this happen? Because we have a lot of people in the industry that have not been in the industry. And when times were really, really good, they could put up anything and it would fill up. Now, if you've ever developed or ever looked at real estate, there's a few metrics that mean a lot, like rent per square foot. You can figure out how to maximize rent per square foot by adding in small units like this, because the rent on a per square foot basis on a unit this size is way more than a big unit like a 10 by 20. Because if you charged the same price per square foot on this unit as a 10 by 20, no one could afford the 10 by 20. What that means is, in a spreadsheet, the more of these, the higher your gross revenue. And the more 10 by 20s or RV parking, the lower your total revenue. You can see how that can really skew what you build. But it doesn't matter what the rent per square foot is if nobody wants it. That means it's zero. This is what happens, including in the example that I showed you that we had to remove walls. They had 5 by 5s and they had lots of them. Nobody wanted them, so the actual revenue per square foot on the 5 by 5s was like 20 cents because the vacancy was so massive. It was completely opposite of what they thought or intended. Perfect example of product market mismatch. When we look at the markets and we're trying to figure out, more important than revenue per square foot is demand. Demand changes. I've seen two major changes throughout the industry in the last 20 years. Prior to 2008, lots of facilities had smaller units. After 2008, we saw a major shift into big units and demand for big units. Now, there's a lot of economic reasons on why, I think including low inflation, people were moving, they were going into smaller houses, they were downsizing, and people changed what they valued, and people bought toys. They wanted to play outside, and all of that stuff required bigger units. The second shift is the one that we've seen this year. So when the self-storage bubble burst, the biggest hit on units, as you can see here, was in large sizes. That is due to inflation. When your purchasing power is eroding away because groceries, everything else costs more, you can't finance toys anymore because of increased in debt cost, you don't have things to store, and you're much more price sensitive. Now, we actually look at this price sensitivity while we're analyzing these markets, but we have seen nationally a big shift. So the units that got hit the hardest this cycle were the larger units. We've seen large drops in rents, like the Wall Street Journal pointed out, the largest rent drop in history, which was really a lot of those big units. Demand evaporated, and we shifted to smaller units again. Now you can see the inherent problem with this. When buying or building a facility, that demand may have shifted. And if you don't know, you have a lot of assumptions walking into it that may never be able to be met. Like, I'm going to push rates on these units, while in reality, over the next 2 years, that size actually may not do well. Know your customer, know their sensitivity, and look at those price points. Are those big units at a point where there's no more rate runway? The rate has no more runway left. It's over. There's nowhere for it to go anymore. They're tapped out. The demand is not there. That means it's negative. And over the next few years, you should actually see a weakening in that unit type. So, what to do and how to offset this and how to change things to make occupancy rise and put yourself in a place where you're competitive, but then you can start raising rates. Let's talk about it. Occupancy and revenue doesn't mean they're correlated. That doesn't seem to make a lot of sense, but it's true, meaning that occupancy can be dropping, but revenue could be rising. This is actually happening on almost all our portfolio in today's age. The reason being is this: rate management. Meaning street rates are dropping, in-place rates are going up, occupancy is going down, but the price of all our units are always changing. So some people are getting higher rents, others are getting lower rents. This is dynamic pricing. It's what they do in airlines, and it's also what they do in hotels. And self-storage, we've figured out how to harness and use that power to our advantage. So occupancy doesn't necessarily correlate with revenue. So we've covered a lot of things in this video, including rates, occupancy, how to be more competitive, what to look out for. Now, a lot of you may be wondering, all right, how does this play into underwriting and what do we need to do? Well, you can check out this video right here that's an underwriting 101, and you can use this information that you've learned to apply to that. Also, check out the podcast, Self-Storage Income, and that's going to tell you a lot about what's going on today. We cover these topics regularly.